Thank you, Fraser, for that introduction. And whether you're watching live or tuning in, hello to all of our viewers. Thank you for making the time to join this panel. We really are, I guess we really have a whistle-stop tour around the world of infrastructure. I think looking at allocations, largely with a focus on the listed world, but also some thoughts on listed and unlisted, also some input around clean energy, and later going on into a discussion. I'm just going to set the scene, and I guess just by way of introduction, my name is Anish Bhutani. I work for a firm called B Finance. I lead our coverage of the infrastructure space. We support institutional investors around the world in making allocations to the asset class, typically in the form of manager search and selection exercises. And I would really say that the information that Fraser just put on the screen a few seconds ago really resonates with what we're seeing. That yes, while a number of our clients do allocate to unlisted infrastructure, there's a growing appetite for the listed space. And I guess there are a number of drivers for that. Particularly around, and I guess on this page we can see the comparison between listed and unlisted. But I guess just to capture some of the themes in terms of what's drawing appetite towards listed, number of investors see it as a completion strategy. I think there's some viewers here today from Australia. I think Australians are amongst the most mature and advanced allocators to infrastructure. We see a number of investors think about having very large infrastructure allocations and seeing room for a liquid as well as an illiquid part of the portfolio. Speed of deployment. I think that I'm sure we're all aware there's a significant amount of capital that's been raised in unlisted space, and an enormous amount of dry powder, which has implications on the amount of time that it takes to put money to work. One of the great benefits of listed infrastructures, once capital is committed, it goes into the ground right away, even sooner and faster than an open-ended fund, which can take a few months. Finally, last but by no means least, from a portfolio perspective, of course, listed infrastructure can bring great diversification and volatility reducing characteristics. I'm not going to spend too much time on this next page. I guess this is just an extract of something that we saw from the Future Fund annual report. I think just really supporting the point made around, investors seeing some investors seeing listed infrastructure as a completion strategy to the overall portfolio. Sorry, I think I need to go back a slide. There we go. I guess a question that we often get asked is listed infrastructure just the preserve of smaller plans? I'd say absolutely not. Yes, a number of defined contribution plans that value liquidity see an important role for listed infrastructure and find it easier to access than unlisted. And especially those investors, those particular investors that are fee sensitive and fee conscious, making listed infrastructure much more accessible. I guess the other point beyond the completion strategy and the speed of deployment, sometimes we see regulatory drivers in certain markets. Recently working with a sovereign wealth fund that has challenges in investing into international infrastructure, unlisted international infrastructure, but could do so in the listed space. And we recently supported them in making a fairly large allocation to the asset class. I'm not going to go through all of the points on this page, but I think that there are some interesting takeaways there in terms of the differences in the manager universe. We see around 25 managers, and there are a number of people ask us, well, are all listed infrastructure managers the same? I'd say they're different from a philosophical point of view in terms of whether they look at it from a top-down and bottom-up perspective, or are they a lot more systematic in how they go about thinking about their portfolio construction. Are there some that are very benchmark aware versus those that take a much more activist approach, thinking about off benchmark positions? That really does impact the size of the investable universe. We see some managers with a long list going up to 400, others with much narrower lists, which are maybe much more systematic in their nature. Looking at geography and sector, and Shane and Darren are going to come on to this later. yes, a large part of portfolios is veered towards North America and towards utilities, but we are seeing growing allocations to Asia and LATAM. I think what's interesting, and maybe a function of the way sectors are classified and defined, is around renewables. We see very little explicit exposure to renewables. And I think we'll come on to Steve's section about how actually renewables are forming a growing part within the utilities opportunity set. Finally, when we just think, I guess, a couple of more points just in terms of portfolio concentration, I think what was interesting to see from a recent search is, top 10 holdings typically account for 30 to 40% of portfolios. I think what was interesting was, despite the differences in these managers, this is analysis that we did looking at the top 10 stocks of 10 managers that we looked at in the final stages of a search. High degree of overlap, even those that are systematic versus those that aren't, those that are benchmark aware versus those that aren't. There's quite a high degree of overlap. You can see this, of the 10 managers, 6 have an exposure to American Tower, Transurban, Crown Castle, and National Grid. So there's a high degree of overlap there. I think finally, another key attraction of listed infrastructure is clearly the downside protection in volatile markets. And an interesting feature of our analysis is thinking about that downside protection, but also upside capture. And again, just looking at the 10 managers that we analyzed in detail, it's not surprising to see that the downside capture, certainly not 100%, it's somewhere between in that 50 to 70% range, but also there's a healthy amount of upside capture too, again, in that 50 to 60% range. I guess if there's one observation, perhaps Fraser will be pleased to see that the GLIO index, I guess above all of the strategies up there, I guess, Fraser, if there's one takeaway from all these observations is that GLIO, a GLIO ETF is long overdue in terms of these metrics and what we're seeing. But I'll take a pause there. I think it's fair to say that the listed space is here to stay. It's an important source of capital for markets, and certainly it's not an either-or argument between unlisted and listed. And I'll hand over the mic to Shane and then Darren from ClearBridge and Invesco to share their perspectives and what they're seeing from an allocations perspective and from a strategic perspective as well. Thank you for your attention.
Thank you very much, Anish, and certainly thank you, Fraser, for the opportunity to discuss listed infrastructure on such a great stage. So I'm just going to spend a few minutes talking about, firstly, our product, then our definition of infrastructure, and then finally, what themes we are seeing permeating through the global listed infrastructure space currently and how we're accessing it as a fund manager. On this slide, we actually talk about the global infrastructure income strategy, one of our flagship strategies, along with the value strategy. And really what's important for us is really summed up in that investment objective. And that's to provide long-term inflation-linked capital growth through a cycle and really extracting those underlying global listed infrastructure qualities out of those infrastructure assets. And so the way we think about our philosophy is really taking an unlisted framework to listed markets. We have a strong focus on underlying assets, those cash flows, the regulatory dynamics, the concession structures. We have an absolute return approach, which means that when you looked at initial slides a few slides back, we actually did look quite different to a number of the other managers on that slide. We certainly use liquidity in the market to exploit mispricings and myopia, and we saw that last year during the COVID period. And it does allow us to do things like hold a substantial amount of renewables, contracted renewables, whilst others may not necessarily hold those. In terms of our investment principles, really a strong focus on regulated assets and user pay assets. The team itself is one of the largest and is built around cognitive diversity, lots of challenge, lots of discussion. For the income strategy itself, we are targeting a 5% dividend yield through the cycle with some growth and some capital upside. A little bit different for the value strategy, where it's a more balanced income and capital total return. Finally, we really have a very strong sustainability and ESG focus, and that's captured in our cash flows as well as our hurdle rate. We put together a proprietary scorecard using our infrastructure expertise, and that scorecard really shapes the way we engage with the companies that we invest in. Portfolio construction wise, we have a fundamental approach, very deep, detailed asset-based approach. We spend a lot of time thinking about why our view may be different to the markets and how to exploit those opportunities. And finally, most importantly, we found that, you know, what's key is we don't lose investors' money. Risk management is absolutely crucial, and downside protection is crucial. So we focus a lot through our process on that risk management. Okay, so really this is our definition of infrastructure in a nutshell. Regulated assets, user pay assets are the core of how we invest. Your regulated assets are obviously your utilities, your poles and wires. Your user pay assets, your roads, rail, ports and airports. Where we don't invest, and this is a big distinction, is in those more volatile cash flow assets. Those assets leverage to commodity price sensitivity, those assets that may be engaged in retail generation, the component manufacturers of clean tech. We find those assets don't give us that cash flow profile that our investors expect, that very stable, growing cash flow component, and that translating into very stable risk-adjusted returns. We also don't invest in community social. Frankly, there isn't enough liquidity in the market, and you do suffer from concentration risk there in terms of counterparties.
Thank you, Shane. I think
I'm just here we go. 1 second-ish. So the slide's a little bit slow on the uptake. So in terms of public and private opportunity, you know, this slide itself is really crucial. What it tells you is a number of things. Firstly, it tells you the growth of both listed and unlisted infrastructure, and we've seen that over the last 20 plus years. You can see from the chart, listed infrastructure currently sits at around about 3 trillion in terms of the market cap, and you look at the frequent value of unlisted, and that sits under 1 trillion. So 3 times the size listed infrastructure is of unlisted. What's important for us is the quality of the infrastructure within our universe has actually improved over the last 20 years, and you can see that through our improvement of what we call our infrastructure quality score, as well as our ClearBridge infrastructure score. I think what's also really important when you look at this is the build-up, as Anish mentioned, of the dry powder. So roughly 300 billion of dry powder, and what we've seen with that build-up of dry powder is increased investment into the listed space, whether it's acquiring minority interests in US utilities, whether it's taking whole companies private in the case of AusNet Services in Australia. You are definitely seeing that creep of unlisted money into listed markets where they can find attractive valuations to deploy their capital. So just one more slide here, a little bit slow in terms of the way these slides are moving, but on our themes, sorry, maybe next slide, doesn't appear to be changing. Thank you. So frankly, these are the key themes and opportunities we're seeing across the space. The first is decarbonisation. Obviously, infrastructure and utilities are at the absolute forefront of decarbonisation. You know, massive amounts of investment going forward, whether it's, you know, 6 times the amount of renewables generation expected to be deployed over the next 10 years, or strengthening of grids. We are able to access that through our contracted renewables exposure, companies like Clearway Energy, Next Era Energy Partners, the decarbonisation thematic, the strengthening of grids, strengthening of networks, the enforcement of those structures, which ultimately will lead to greater electrification. We're able to access those through our utilities exposures globally. In terms of another thematic which we think is really interesting is really the simplification of global utilities. So again, what we've seen over a number of years, whether it's in the US in the case of Exelon, Public Service Enterprise Group, or in Europe in the case of SSE and a variety of other utilities, they have been simplifying their assets and selling their non-core assets. What this really leads to is a re-rate of those underlying securities and a much cleaner investment for us to invest in to deliver those cash flows to clients. Recovery has obviously been an absolutely crucial thematic since COVID last year, and we are seeing value in the transport and infrastructure names who have recovered in terms of traffic and haulage in the case of the rail names in the US, but in fact really haven't recovered their pre-COVID levels in the case of the airports and certainly the toll road names in Europe. So again, significant value in those transport infrastructure names. You know, I guess finally, the 5G evolution is really apparent. The huge demand for data we are seeing playing out through our listed tower companies. What they are able to do is exploit the huge amount of capital being spent by the carriers to actually grow their ability to supply greater data to the ultimate consumer as we move from 4G to 5G and then possibly at some stage out to 6G. So I'll stop there and turn it back to you, Anish.
Thank you, Shane. Thank you for that very helpful overview. And perhaps I guess interesting to see the approach there of Shane, and I guess philosophically looking at infrastructure. I'll perhaps now hand the mic to Darren Turner at Invesco, and perhaps you can walk us through your perspective on the listed space and some of the things that you're seeing, please.
Yeah, happy to. Thank you, Anish, and thank you, Fraser, and everybody on the phone today to give us or provide this opportunity. So I'm Darren Turner, Chief Investment Officer for Invesco Real Assets. Obviously, as that name implies, we cover the entirety of the real asset class. Global infrastructure is a very significant part of how we view this asset class and what it can provide underlying clients. Now, we view ourselves as hard asset experts, meaning that everything we do is focused at looking at heterogeneous assets that provide a level of income backed by long-term contractual cash flows. And so our approach when looking at infrastructure or real estate or gold miners overall is to first put quality of asset, quality of market, and have that be the driver of really how we're thinking about where do you want to be positioned. So a very large part of our process is focused on relative quality of assets and understanding what are the underlying drivers for that longevity of cash flow stream related to that asset. Now, I'll speak to this in a little bit more detail. Our valuation approach, though, becomes very localized, meaning that depending upon the sector in the region of the world that we're focused on, we will take a different valuation approach given what is the dominant local investor for that market. Now, in addition to that, when we think about risk management, we're trying to provide a very high level of idiosyncratic risk in our portfolios. We want to be taking very low factor exposure or systematic exposure because we are trying to provide what we believe to be an infrastructure fundamental exposure to our end clients. We want to make sure that it's providing the stability, the diversity, that level of income that really people are looking for from the overall asset class. As Anish really pointed to earlier in his presentation, one of the things in my next slide speaks to this is what are our clients when they come to us, what are they looking for from listed infrastructure overall? And what they're really focused on at most times is a completion type of solution for their private infrastructure portfolio. And maybe if someone can turn to the next slide for me. And what you see is that there are some major differences in listed versus unlisted infrastructure from a diversification standpoint. Now, again, Anish hit on some of these items as it relates to country allocation or as it relates to sector allocation overall. But for the most part, you're going to get more diversity, more ability to invest across sectors within the listed infrastructure space. And so when we speak to clients, we get a lot of questions about, I want exposure to this part of infrastructure because I can't replicate it in a private fund format. And so a great example is cell phone towers in the US. Trying to replicate that exposure is very hard for the private investor, considering some of the monopolistic type of business that the American cell phone towers currently run. And so we are very willing to always work with clients, not only thinking about a global listed infrastructure allocation, but then also understanding where are their needs in their portfolio, either, again, from a regional perspective or a sector perspective, that helps them round out to get a true, in our view, a true underlying infrastructure exposure within their portfolio. Turn to the next slide, please. Now, as it relates to our approach, again, we very much are focused bottom up from a fundamental or quality standpoint, but we also want to make sure that we're incorporating what I'll say is a multi-factor approach as it relates to valuation. When you think about incremental dollars of listed infrastructure in the capital markets overall, dedicated infrastructure managers are not the majority investor. And so even though we believe you do have to take an infrastructure IRR approach when understanding that valuation, we think you also need to have an overlay of what is that generalist investor thinking about from either a valuation standpoint, from a yield standpoint, and how does that apply to specifically either that sector or country. And so what we show on this chart is kind of a 4-quadrant of how we change our valuation technique as you move, again, across the world between sectors. And so as an example, if you're a midstream investor in the US, midstream investors move from a dividend yield or a price to cash flow type of mindset and are now much more focused on EV to EBITDA. Now, that can be very different than how US utility investors think about valuation. So most utility investors are focused on a PE type multiple. And so our analyst team, depending upon what sector we're focused on, will change their valuation framework that is used, again, as an overlay when we're looking at true infrastructure IRR underwriting overall. And then one more slide, please. And then lastly, just the amount of client conversations that we've had on the infrastructure side has definitely picked up in 2021. The main driver for that increase in conversation relates to inflation. So historically, when you look at the listed infrastructure space in relative performance versus general equities, where you see the greatest divergence or the greatest outperformance of infrastructure has been when you have high periods of inflation. So what is the driving force behind that? It really is the explicit nature of an inflation linkage as it relates to contractual cash flows. And so on this slide, we give a couple of different examples. So midstream or pipelines, airports, toll roads. And if you look at the rate adjustments, all of these have some type of either global or local inflation rider built into their contracts. And so that is very unique from an asset class perspective. And a lot of investors have been talking to us about this as it relates to how are we thinking about cash flow improvements moving into 2022, as you've seen very widespread inflation increases across the world this year. And then what is the impact going to be even on a 3-year basis as we move forward? So again, I would say the amount of client interest and demand has definitely been higher today than it's really been for the past 3 or 5 years. Now, much like Shane was mentioning some of his overall themes and areas that they're focused on, we actually line up pretty well in a lot of those aspects. What you don't see on here as it relates to having an explicit inflation in their contract is cell phone towers in the US. That is an area that we still very much favor, and that is driven by the 5G build out that we're seeing by Verizon, by AT&T overall. And so when we think about our portfolios, we think about those that are economically sensitive, much like what is on this slide, and those that are more structural in nature that can have drivers outside of the economic cycle, like the cell phone tower business overall. And so today we're seeing opportunities in both of those segments when we're thinking about relative value. So I'll stop there and turn it back to you, Anish.
Great. Thank you very much, Dan. Really interesting set of slides and really interesting set of perspectives provided. And just before we move on to Steve, maybe if we quickly just touch on a question, maybe for Shane and Darren, if that's okay. And I guess it'd be interesting to just understand to what extent does geography shape your perceptions and perspectives as far as the listed asset class is concerned. You know, in the US, there's clearly a large MLP space, for instance, and listed REIT market. Does that impact the way that a listed infrastructure manager based in the US with a high number of US clients looks at the space? And also maybe Shane, for you, your perspective, Australians being very large unlisted infrastructure investors. I think there's an interesting graphic there that you know, Australian assets have high dividend yield. Think about core infrastructure. Does that shape the way you think about the asset class from a portfolio construction perspective? You're very welcome to disagree and say that's a very lazy, casual, and ignorant observation. So, but perhaps it'd be good to get your perspective.
Yeah, I'll jump in maybe first just from a U.S. investor perspective. I would say most of our conversations with U.S. clients can be dominated with wanting U.S. infrastructure exposure. Now, as you highlighted in this, once you get in more detail around that conversation, what people quickly realize is that it's heavy utilities, heavy midstream energy, and then potentially a couple of the rail names or the cell phone tower names. And so you can't really get that airport exposure or that toll road exposure as clean as you can being an investor in the European markets. And so I think there's a lot of educational conversations that we have with our client base when they start getting too focused in one region of the world versus another. And then the only other comment I would make there before turning over to Shane is, as a global infrastructure investor, when we think about regions and being an investor in that region, it's really focused on what is the stability of that regulatory framework. And can we look at prior case law? Do we have a clear understanding of them withholding what is the regulatory type of framework? And so that's always very high on our investment checklist when investing in certain markets.
Yeah, look, and thanks, Darren, and thanks, Anish, for the question. I think from our perspective, you know, really it is a bottom-up, risk-adjusted decision. So we have long-term IRR. We run a long-term IRR calculation based off the fundamental cash flows the asset's throwing up. We compare it to our hurdle rate. We get an excess return. We then look at that within a number of risk measures to make sure we actually understand the upside and downside. And then that forms kind of the first step of how we would invest in the space. Now, on top of that, we do have regional and sector guidelines, but importantly, to your question, you know, definition is very important because we want to deliver that very stable cash flow, that growing cash flow, those dividends that as Darren pointed out, that really have that pass through of inflation, which, you know, infrastructure is, you know, probably, you know, you would say neutral to positively correlated to inflation for the most part. So that is important because the construction of the portfolio reflects the underlying fundamentals and not a top-down view on the world and what the market is. We are, you know, purely listed infrastructure experts, and so for us, what's important is the valuation of those assets relative to our hurdle rate. It does kind of dovetail very much into our unlisted approach for investing in listed markets, because what that means is really we look at the best opportunities by region and then risk adjust those. As an Australian investor, it is interesting. I mean, you know, frankly, we don't have a lot of allocation in Australia anymore, and we haven't for a number of years. Not that there aren't high quality companies, you just don't have the breadth in the Australian market of infrastructure and utility assets. So to Darren's point, I mean, if you want to access a global utility or a US utility, very deep, some of the highest quality utilities in the world are based in the US. And so, you know, we are very much a global manager, and you know, from a client perspective, they want that global exposure. They don't necessarily want, certainly unlisted clients, they don't want that Australian specific exposure because they can get that themselves either directly or through their Australian clients. I may throw it back to you there, Anish.
Great, thank you. And maybe we'll come back to some of that when we enter the freeform discussion. I guess next on the agenda, I'm really pleased to introduce Steve Fleischman of Wolf Research. Steve is a managing director and senior analyst at Wolf Research. His team covers utilities, power, renewables, and midstream sectors. And Steve, I understand, has been Wall Street's top-ranked utility analyst 14 times. Is that right, Steve, or is that outdated? Are there a few more since I got that stat? So it's really an enormous pleasure to have you here on this webinar, and it'd be great to get your thoughts around the clean energy play, particularly in the US landscape. I guess a number of interesting sector trends that we're seeing. Without much further ado, I'll hand over the floor to you, Steve.
Great. Thanks, Anish. And that intro made me blush a little bit, but I'll appreciate it anyway. But yeah, I thought, as Anish mentioned, we, as my team covers the utilities and midstream sectors, and I've dealt with many of you since we cover a lot of the companies, at least in the US, that make up the global listed infrastructure sectors. So what was interesting this year is we decided to pick up the clean tech or clean energy space. And it's given us, I think, some good insights and also brought a lot of questions from folks in the listed infrastructure space of just how does this fit in terms of their investment process, both in terms of are there opportunities in this space that might fit from a business standpoint? Are there risks to core utilities you're finding as you do work on this space? And also, why have investors not looked enough at utilities to play clean energy, since they're obviously doing a lot of it as well? So I wanted to address some of those topics in the context of what's happening in clean energy. So, oh, I guess I went the wrong way. But okay, so we're excited to cover the clean energy space. We do think this is secular growth opportunity, and probably one of the biggest we've seen in our career covering the broader energy space. We do think investors need to have exposure to it. And I'll show you in a minute the Wolf Green playbook, which is a way to kind of just segment the different companies and what they do. There's a lot of mega trends supporting this shift: climate change, decarbonization, the shift to more climate and ESG focused investing, electrification, the move toward more distributed energy resources, particularly as we see the ramp up in EV adoption, and then even talking about green hydrogen. There's also strong, customer demand for this shift. There's public policy support, and at least in the U.S., a big focus on this specifically with a big Build Back Better bill that could be decided early next year. We have a slide talking about, the Build Back Better bill here for a second, some of the key provisions. I'm not going to go through this now. However, it would be pretty meaningful, game-changing bill for investment and visibility for investment in US renewables, both wind and solar. It would also allow for more focused investment in battery storage. Right now in the US, you need to have batteries attached to a solar facility to get a tax credit. If this provision passes, you can add batteries next to a wind facility or batteries on the transmission grid. So expand the options of implementing batteries and get a tax credit. It would dramatically change the structure of existing nuclear in the US, particularly the unregulated nuclear would now have a long-term tax credit and turn it into a more contractual business, at least for the next 6 years or potentially more. We get a big tax credit on green hydrogen, enough to make it economically competitive pretty quickly. There's a lot of focus within the bill about domestic content and focus on bringing manufacturing capacity to the US and tax credits tied to that. And then lastly, particularly helpful for some of the utilities and some of the smaller renewables players, there's a ability to get direct payment for the government for tax credits, as opposed to having to find intricate structures, tax equity, to get paid for tax credits, make it a lot easier and potentially more cash flow friendly to invest in renewables. So this would be a really big deal if it passes. We think the odds are better than 50-50. Politics in the US are never easy to fully judge, but part of the thought process is how big a disaster would be for the Democrats if it doesn't pass, since they're really in the driver's seat of whether this passes or not. Okay, so Wolf Green playbook. Most investors in the US to play what we call the green trade have bought this top group of companies. These are pure play clean energy companies, residential solar companies, inverter companies, battery storage, panel makers. Those stocks went up dramatically last year. They've been on a roller coaster ride this year, up and down. I'll talk in a minute. None of them are really infrastructure plays. They're either manufacturers of products or new technologies. In the case of residential solar, they are a little bit more like contracted power companies, but just with very complex financials and the like, that I think most traditional infrastructure investors probably not going to get easily accustomed to. But there are a lot of other ways to play clean energy. Shane mentioned a few of them, such as the yieldcos, which are vehicles to own operating infrastructure assets that are aligned with strong, at least these days, not in the old days, but these days, aligned with strong parent companies. There's offshore wind plays that several of the US utilities are involved in, and of course, Ørsted globally. You've got a couple leading renewable developers on the non-utility side, like NextEra and AES. We'll talk in a minute. We think nuclear will get in the mix here too. But then there's a whole bunch of utilities that we think ultimately will be part of the green transition. Some in the US have been earlier movers, like Xcel or Dominion, Alliant. But then there's a whole pack of others that will increasingly get there over time. And some of it depends on the environmental policies and preferences of the individual states. But all of the utilities are moving in that direction in the US. So now for the so why would anyone own utilities to play clean energy when the pure play stocks seem to be the ones that move the most and the most money to be made? We think, first of all, in the end, regulated utilities will likely be the largest group of investors in terms of actual dollars into clean energy transition. And on top of that, we think electrification will increase demand for the product. So we should see better demand growth than we've seen in a long time, supporting rising investment. And then we think the risk reward model of utilities investing in clean energy is attractive. It's maybe not the highest reward potential, but also well below average risk. There's low technology risk. You're just going to use whatever the best technology is at the time, get it deemed prudent by your regulator. And so you're not betting too much on one technology versus the other. There's limited competitive risk in the business, whereas the pure play is a very competitive, pretty stable model. And the utilities ESG positioning will get better every year. Maybe it's not the best of now, but it's going to get better every year. We do think, as part of our work, that the grid will still be a key part of how electric service is provided for many decades to come. We do think the distributed resources will proliferate. There'll be more interaction between utility grid and distributed resources, but ultimately people will stay very reliant on the grid. It's not going to go away. We're not all going to disconnect. That said, we do think utilities need to be careful that they make sure their regulatory structure evolves to kind of incorporate these changes. And we think that's where there is the risk of some disconnects. In fact, that's right in the mix in California as we stand today. So what's been the problem with utility stocks? You know, we're in a bull market. It's not a popular way. People don't care too much about risk right now, or haven't. And so investors have tended to prefer high beta, high risk stocks to play clean energy, just because of that. And people are just not too worried about the competitive risk, technology risk. They're kind of buying everyone and think in the end, as long as they get a couple of the winners, it'll offset the losers. And the business model risks are downplayed. And then the last thing that's been in the way is there's a lot of bias against any legacy coal, even a little bit, even to some degree gas assets. And in many of our conversations, companies are just disqualified because they have coal today, even if they're going to get out of it in 5 years or 10 years from now. It's not fast enough. So that's definitely an issue. It will go away over time, but it's a hindrance today. The last point I wanted to make is we do think US nuclear could become an infrastructure asset, not necessarily in any traditional sense, but we do think if we do get a PTC in the US, it will likely get extended over time, and the need to make sure US nuclear stays open, it's carbon free, and needed for reliability could turn it into effectively a contracted business. So that may not be on anyone's list of top ideas for infrastructure investment, but we do think that business model could get very interesting over the next 3 to 5 years here. So those are some thoughts, and let's have a good discussion.
Thank you, Steve. Really a lot to unpack there, a lot of interesting thoughts and ideas. So thank you very much. But perhaps if I pick up on that last point that you made, and maybe just bounce it around the panel as well, around potential for nuclear to be an infrastructure asset. I guess one of the natural questions that comes back is around ESG. Will that fly with investors' ESG concerns, and questions around ESG ratings? Shane, Darren, is there anything you'd like to pick up on that? Do you see a role for nuclear within a listed classified as a listed infrastructure sector?
Yeah, look, maybe I'll kick off and then I'll throw to Darren. The answer is yes for us. I mean, there's no way in my mind that you could see a transition anywhere near to net zero in 2050 without some stable baseload that's lower carbon emitting. So if countries are retiring their coal, if they're investing less in gas generation, something needs to be kind of that baseload generation that at least shorter term stabilizes the grid, because obviously batteries, hydrogen, longer term may be able to stabilize grid through their ability to use kind of peaking capacity or batteries in terms of storage. So for us, nuclear is crucial. We hold it in the portfolio through a number of US holdings. I think globally you're seeing it being recognized. Steve mentioned triple B. Are you seeing it also in Europe with a possible classification of sustainable fuel? And you're seeing it with the extension of life for nuclear plants all around the world. So we think it is absolutely crucial for the future if we are going to decarbonize.
And I completely agree with everything Shane just said. Yes, it's absolutely something that we do currently invest in through some US companies today, but also something that we would continue to consider as we move forward. We do think it's going to have to play a key role as we go through this transition. And I think that just the acceptance and people really recognizing that is slowly changing. Now, the only other comment I would make there is some of our investor bases, nuclear is an absolute exclusion. So where we sit, that would be a further conversation that we would have to have with certain people. It's just, where is the starting point? Now, from us, again, as an investor, we think it is absolutely the right thing to be doing. It's just, again, educating our investor base out of certain regions around why we think that that is the appropriate approach to be taken.
Steve, anything to add to that from your side?
Yeah, no, I would say it's fair to say that there's still some skeptics out there, just given the history or some of the bias in certain parts of the world. But I think it's funny. It's one of the few things here in the U.S. that maybe the Republicans and Democrats agree on right now, might be that we need to keep nuclear around as part of the fleet in terms of power transition. So who would ever thought that of all the topics that would be it? But it's something that I think has just got a lot better recognition here, and we've had a lot of I didn't talk about some of the risks of clean energy transition, but we've had a lot of issues arise in California, in Texas with Uri, in the Northeast. So, I think there's a better recognition that there actually is risk if you don't do this carefully.
Thank you. Almost moving in reverse order, I guess the penultimate point you made, Steve, was around utilities not necessarily benefiting from the bull run. And I guess something to just pick up on with the panel is, do we think that the clean energy technologies, assets within these broad diversified utilities can be ascribed at a fair value? Will there always be a valuation disconnect? Will there always be lost in the sum of the parts? We saw, maybe speaking from a UK standpoint, in the last week, I think there were calls for SSE to be broken up by an activist investor. So it's an interesting topic there. Steve, you clearly see there is an opportunity for clean energy within utilities, but be interested to hear the thoughts of the panel. Are clean energy assets better off on standalone, unlisted, to be ascribed at fair value?
Darren, do you want to go first on this one?
Yeah, sure. I'll go first. I think Steve hit on in his slides. I think when you look at why you've seen such a significant price appreciation in a lot of the clean energy side, is people are just saying, I want exposure to this theme. Give me as clean exposure as possible. And I don't really care about the risk today because I believe in this long-term thematic shift. Now, what we think eventually does happen is that not everybody's going to be a winner in this space, and people are going to understand that the way some of these companies are capitalized, how technology is going to evolve through time, there's going to be some very clear winners and losers, and people are going to understand that maybe I don't want just pure beta exposure to this segment of the market. Now, within the utility subset specifically, we think really controlling more of the value chain in energy is actually a big positive that the utilities have versus if you're just a renewable focused person by itself. And so a company like NextEra, as an example, we think that that is actually one of the best ways to play kind of this clean energy revolution moving forward, is because they have the scale, they have the balance sheet, they have access to capital markets, and again, they control a significant part of what the value chain is. And so being able to understand your customers, being able to understand the energy production side, we think that that provides a more likely a higher probability of long-term success. Now, again, maybe it's not going to be the highest returning part of the clean tech subset, but what we're focused from an infrastructure standpoint is stability of return and stability of cash flow. And so we think that that does deserve a good look with inside your portfolio.
Yeah, and just to add to what Darren said, I agree with a number of those things. It really is about the volatility of those outcomes. So if you invest in clean tech assets purely, some of the names Steve put up the top there, the trading of those, the cash flows, the returns, for us are not really infrastructure-like. And so we are happy to take the exposure of renewables through our utilities businesses. We think they're massively undervalued within these businesses because ultimately, as Darren pointed out, it's about the fact that these utilities control their customer, control their networks, and can actually every step of the way down the value chain exploit those opportunities. So, we think for us, will there be a disconnect in the sum of the parts? Possibly. I mean, you've seen that in many parts of the world. Just look at Iberdrola and EDP. That's another example of where they're not trading true to their fundamental value. But over time, just like we've seen US utilities simplify their models, spin off their non-core assets, you'll probably likely see that more and more when you aren't getting the valuation you deserve in your underlying businesses. And just like every industry, they evolve. And just like every industry, what you'll likely see is a number of these renewables businesses spin off if they're not getting recognized for their true value in their current pricing.
Thank you, Steve. Anything to follow up on your side on that?
No, I think I'm good. Thanks.
Great. I'm conscious of time, and just look, it's been great to hear a wide range of perspectives over this last hour, and time has really flown. Perhaps just to sum things up, perhaps I just pass the mic across the panel just for some closing thoughts with regards to the future for listed infrastructure. What are your thoughts around that, and in terms of that opportunity set and the growth prospects going forward? Who'd like to start?
I'll start with just a couple high-level comments from me. I think when we think about the listed infrastructure space, we still view this as an industry that is still really growing, in that when we think about the next 10 years to 20 years, and Fraser put up some numbers around this, we think that this is going to be more and more of a focus for investors over the long term, and as they think about their allocations and what the asset class can provide their portfolios. So even though obviously infrastructure has been around for in the Australian markets and then in Canadian markets for a longer period of time, we think a lot of the other investors in some of the other regions are really just now starting to look here. And so we get very excited when we think about what is the long-term growth and how successful can this industry be. And then the last comment for me would be, just as we go through this evolution on fixing and improving our infrastructure, going from an energy transition, and then just from a technology build-up standpoint, infrastructure is going to be a key theme really across all of this. And so we think that you're going to continue to see very attractive opportunities on a global basis, on a sector-by-sector standpoint. So again, something that we get excited about talking about, and we always look forward to having future conversations with clients.
Yeah, look, from my perspective, we're at an absolutely pivotal time in terms of key thematics driving growth in the infrastructure landscape. I mean, you have changing demographics, you have decarbonisation. We've talked about the huge demand for data as it relates to benefits of tower companies. So there's a number of very strong thematics that are going to lead to very strong growth in infrastructure names. And I guess the beauty is, if you have the right definition of infrastructure, then you get the right types of stable cash flows, growing cash flows, and volatility out of that. Layer on top of that liquidity and the ability to move in and out of these companies, like we saw during COVID, to take advantage of dislocations. And really for us, the listed market is a very attractive place to be. 3 times the size I mentioned before of unlisted capital, and really only able to access certain companies within listed markets. So you want to invest in a US railroad, very difficult to do that in unlisted. You look at the size of of global utilities, 1.7 trillion market cap. Compare that to the private market, it's 100 billion. So layer on top of that what we think is stronger ESG practices and more heavily scrutinized sustainability practices in listed markets, and we think there's a very bright future, and that growth, as Fraser has in a number of his charts, will continue to grow for years to come. And 3 trillion may very well become 4 or 5 trillion in the next few years.
Yeah, the last point I just thought I'd note is, and again, my focus is a little more US, but one thing I've noticed is that when private infrastructure investors buy stakes in public of some sort, they're paying a lot more than what you could buy the listed assets for these days. And I think that's just really encouraging in terms of just where value is, and maybe there's the markets get very focused on kind of momentum and other things that affect how stocks trade. Obviously been a lot of focus on big tech and things like that, but at some point there's going to have to be some reconnection between private market views of infrastructure and public markets. And right now they're very disconnected, with the public markets being, quite cheap relative to what privates are willing to pay. So, we view that as kind of encouraging. And I'll leave it back to you, Anish.
Thank you, Steve. Look, and I think segues nicely to the point I'd make from my side. I think there is potentially a disconnect. I think what's interesting is also albeit we are in benign markets, in recent years, in the last 10 years, we haven't had a GFC moment. From a fee perspective as well, I think investors may grow to realize that the sort of fee efficiency of their returns is rather strong on the listed side, and that doesn't mean there isn't a role for the unlisted, but unlisted may have a different role to play in the portfolio. But that remains to be seen. And I guess with that,